Airbnbs, there's something for every preference. This isn't just a summit, it's 3 days of insight, innovation, and unforgettable connection in a setting designed to inspire.
This is a summit you don't want to miss. Experience HR leadership redefined.
The Zamara Regional HR Summit is back, and this year it's bigger, bolder, and more impactful than ever before.
Join leading HR professionals from across the region for 3 days of thought leadership, strategic insight, and powerful connections, all in one unforgettable setting.
Whether you fly in, take the SGR for comfort, carpool with your peers, the journey is yours to design. And with flexible accommodation options from hotels to Airbnbs, there's something for every preference. This isn't just a summit, it's 3 days of insight, innovation, and unforgettable connection in a setting designed to inspire.
This is a summit you don't want to miss. Experience HR leadership redefined.
The Zamara Regional HR Summit is back, and this year it's bigger, bolder, and more impactful than ever before.
Join leading HR professionals from across the region for 3 days of thought leadership, strategic insight, and powerful connections, all in one unforgettable setting.
Whether you fly in, take the SGR for comfort, carpool with your peers, the journey is yours to design. And with flexible accommodation options from hotels to Airbnbs, there's something for every preference. This isn't just a summit, it's 3 days of insight, innovation, and unforgettable connection in a setting designed to inspire.
This is a summit you don't want to miss. Experience HR leadership redefined.
The Zamara Regional HR Summit is back, and this year it's bigger, bolder, and more impactful than ever before.
Join leading HR professionals from across the region for 3 days of thought leadership, strategic insight, and powerful connections, all in one unforgettable setting.
Whether you fly in, take the SGR for comfort, carpool with your peers, the journey is yours to design. And with flexible accommodation options from hotels to Airbnbs, there's something for every preference. This isn't just a summit, it's 3 days of insight, innovation, and unforgettable connection in a setting designed to inspire.
This is a summit you don't want to miss. Experience HR leadership redefined.
Retirement isn't an age, it's a financial position. The question is, will you be ready when it's your turn? At Zamara's 4th pre-retirement training, we'll give you the tools to take control of your future before the clock runs out. Over 2 insightful days, we'll cover income replacement strategies, financial and retirement planning, healthcare and estate planning, and how to make the most of your retirement savings. You will walk away with expert-led knowledge, practical tools, and a plan you can act on immediately. Join us on 1st and 2nd September at Zamara Place, Wayaki Way, Nairobi. Imagine it, plan it, live it. Financial freedom ahead.
Ladies and gentlemen, allow me to warmly welcome you to our annual pension convention. This time we'll be holding it in Mombasa at the North Coast. Pride in Paradise, beginning the 22nd, 23rd, and 24th of October. The theme of the conference will be Disrupting for Impact. I'm inviting you as a stakeholder, a regulator, fund manager, custodian, administrator, trustee, HR professional, and anyone who is active in the employee benefit space. Do attend our conference. Let us convene, discuss on the theme of disruption, and see how we can stay focused despite the upheavals, the disruptions that happen with respect to the workspace. See you in Mombasa on the 22nd, 23rd, and 24th of October at the Pride in Paradise. Ladies and gentlemen, allow me to warmly welcome you to our annual pension convention. This time we'll be holding it in Mombasa at the North Coast. Pride in Paradise, beginning the 22nd, 23rd, and 24th of October. The theme of the conference will be Disrupting for Impact. I'm inviting you as a stakeholder, a regulator, fund manager, custodian, administrator, trustee, HR professional, and anyone who is active in the employee benefit space. Do attend our conference. Let us convene, discuss on the theme of disruption, and see how we can stay focused despite the upheavals, the disruptions that happen with respect to the workspace. See you in Mombasa on the 22nd, 23rd, and 24th of October at the Pride Inn Paradise.
Morning, everyone, and welcome to the Zamara webinar on the subject, are you keeping pace with the recent developments that are happening in the retirement benefit sector? My name is Michelle Mwangi, a pension consultant at Zamara, and will be guiding you through this important discussion. Our discussions today will focus on the recent developments that have happened in the retirement benefit sector that affect you and the industry at large. We'll focus on pension reforms, post-retirement medical funds, and gratuity payments. Thank you all once again for joining us today. We're privileged to have with us distinguished panelists who bring deep expertise in matters law, pension, and taxation. It is my pleasure today to introduce our panelists. On my far left, we have Mrs. Stella Ojango.
Good morning, ladies and gentlemen. My name is Stella Musembi Ojango, an advocate of the High Court of Kenya, and it's a pleasure to be here this morning to take us through this very important topic.
Next to her, we have Mr. Anthony Kilavi. Welcome.
Good morning, ladies and gentlemen. My name is Anthony Kilavi, General Manager, Pensions at Zamara. I'm also a council member of the Association of Retirement Benefit Schemes, and I'm happy to be here with you at this webinar today. Thank you.
Next to me, we have Mr. Isaac Kweyo.
Good morning, everyone. My name is Isaac Kweyu. I'm a manager at the Policy and Tax Advisory Division in charge of direct taxes at Kenya Revenue Authority.
Thank you, panelists. Before we begin, I would like to remind our participants that this is an interactive session. If at any one point you need more clarification, kindly feel free to drop it in the chat box below, and we will respond as and when, or at the dedicated Q&A session at the end of the session. Thank you once again for joining us. Before we dive in, I'd like to get a sense of the room. Feel free to type your answers in the chat box below. On a scale of 1 to 5, how familiar are you with the term PRMF? And is your scheme allowing for PRMF? And are you, as a member, contributing to the PRMF? Again, feel free to type your answers in the chat box below. Thank you once again for joining us and looking forward to your responses. Remember, this is an interactive session. Please feel free to drop your questions, your clarifications down at the chat box below. Let's begin, shall we? When we talk about pension savings, what really motivates people is the tax break the government gives you. So to our panelists, how exactly do these tax exemptions work in the pension savings space? And how can our members benefit from these tax exemptions?
Very good question. Saving is not something people do naturally. Yes. Generally, people don't like to save. They like to spend. So, by and large, governments encourage people to save through giving tax exemptions or tax reliefs in various ways. Now, within the retirement benefit space, there is one important tax exemption that is granted or extended to you when you contribute into a scheme. And that is, you don't pay tax on up to 30,000 shillings every month if you're contributing into a registered scheme. Now, that has increased from 20,000 to 30,000, a jump of 50%. government has made that adjustment, upward adjustment, in order to increase the incentive and to encourage persons, members, to increase their contribution for purposes of future retirement. The second incentive is that the investment income arising from those contributions is not taxed. And the third is that when you leave, you can take your entire benefit without tax. But that is if you leave on the basis of retirement or after 20 years of service in a scheme. So in those three ways, we can say that government has extended tax exemption for purposes of encouraging savings. The question then is, are we taking full advantage of those incentives?
Further to what Mr. Kilavi has mentioned, it is important to talk about the exit bit. He has alluded to the fact that you leave at the point of exit, you are not taxed. But let me speak further to that. So what do we mean by exit? Exit is leaving the scheme when you've attained early retirement age, and that is 50 years. There's also what we call normal retirement age of 60 years. That is what we deem as exiting the scheme. The other way you can access this money without any tax is if you are exiting the scheme on the basis of ill health. That has also been allowed. And these changes, I must say, came in last year through the Tax Law Amendment Act of 2024. So as of 27th December 2024, these changes kicked in. And I think this is a very commendable move on the part of the government. So we have said early retirement at 50, no taxation. 60 years, no taxation. Ill health, no taxation. If you have been a member of a scheme for 20 years or more, you also leave with no taxation. Those are the good benefits that amendment brought in as of last year, December. Thank you.
Okay.
Let me also add, in addition to what has been said by Stella, if somebody has been a member of different schemes during their working life, they can transfer their benefit from one scheme to another. And along with the benefits that is transferred, the years of service that they have accumulated in each scheme where they've been a member are portable. So the count to 20 can actually be a count of all the years that you have transferred your benefit across different schemes. And that really means if you preserve, you don't access your money, then you are preparing yourself for taking home a benefit without any tax. And it's important for us to take advantage of this tax incentive.
Okay. Yeah, in addition to what Anthony and Stella have said, I think it's also important to clarify that the tax incentive in terms of the allowable amounts on your salary also includes NSSF. If perhaps you're a member of a registered scheme and you're also contributing, to NSSF, perhaps you're contributing 5,000 shillings to NSSF and 25,000 shillings to a registered pension scheme, the sum total of, that is available for you for as a tax deduction, meaning that your taxable income will be lower. And, secondly, when you're talking about access that Stella has elaborately put it, there are different ways in which one would want to access those funds. Perhaps there are those who will take it as a lump sum, the whole of that lump sum, as long as you met the conditions, either 20 years you've retired because of ill health, or you retired according to the scheme rules, the whole amount will be tax exempt. Perhaps there are those who will opt for annuities. They'll be taking bits in bits. Again, the full amount, as you access those funds annually, will be tax exempt. There are those perhaps will opt for, an income drawdown. It's a form of access of your retirement benefits. All that will be exempt. Then secondly, I think it's also important to mention that, the aspect of having been in a scheme for 20 years, as a condition for you to access those funds, tax-free, that it's possible, for somebody, at 40 years to access those funds tax-free. Perhaps you joined the scheme at 20, now he's at 40. Perhaps you may think that, you have to attain the age of 50 and so on and so forth for you to be able to access tax-free. It's possible that, basically speaking to the young people, it's good to join the scheme, early enough. You'll be in the scheme for 20 years and you'll have qualified, for the tax exempt amount. That's very, very important. And as Michelle, as you have said, how do people, how do people benefit for these particular incentives? Anthony has talked about exemption at the point of contribution, exemption at the point of investment by the pension schemes, and exemption at the point of when you're withdrawing the amount. Now, when it comes to contribution, employers are required to, give this deduction to the employee. It's a requirement in law. If you're an employer, paying a salary and you are deducting, pension contributions and remitting to a registered pension scheme, then you're under obligation to grant, your employees that deduction so that they're able to enjoy, so that they don't have to wait until the end of at the end of the year when they're filing the return, to start filing for tax refunds. It's important that they're able to benefit, in their monthly pay as you earn deduction. I think, Michelle, that's what I would say for now. Thank you.
Indeed, these are wonderful reforms. We've spoken about the increase of the tax exemption limit from 20,000 to 30,000. My question is, with the national average earnings going up, are these current tax exemption limits still going to be enough to encourage people to save? And if not, will there be a mechanism for maybe to review these limits once in a while to keep up with the cost of living? Your thoughts?
Very good question, Michelle. We've actually been lobbying every year. We've been lobbying Treasury. We've also been talking to KRA to see that government increases this allowable contributions without tax. And I can tell you, we've waited for 19 years, right from 2005, when we had the increase from 17,500 to 20,000 per month. Now, we've waited 19 years to 2024 to see an increase from 20,000 to 30,000, which is allowable without tax. So I would say that, yes, we are happy. We appreciate that gesture on the part of government, but we would ask that in future, these increases be more regular and perhaps more predictable, because when they do not happen after so many years, then they cease to be a meaningful incentive. Incomes have gone up. And with that, with those incomes going up, it's only fair that the tax component that one is allowed to contribute into a scheme also go up in tandem and in sync with the increases in earnings.
Further to what Mr. Kilavi has said, it is important to peg these increases, either one, on inflation, or two, the national average earnings. The national average earnings are published each year by the Kenya National Bureau of Statistics. The NSSF Act has actually adopted very well codified for the first 4 years, and then after that, the NAE kicks in. So it's important to also have such tax incentives pegged on such changes that come in. Inflation is definitely eating away on anyone's savings, especially if you're not earning investment income that is above the inflation rate. Then the other thing to look at is NAE. Any of those can guide us very clearly so that the changes are periodic, they are determined. Yeah. We can be sure that after so long, a certain change will come on board, as opposed to waiting for 19 years. 19 years is a very long time.
Yes.
Yes.
Thank you, Michelle. I agree with my fellow panelists. Actually, 19 years are a long time. And, then, it appears the increase, it's a 50%, quite a substantial, 50% increase, quite substantial. But again, as we said, we waited for, 19 years. And in the course of time, perhaps the benefits have been eroded by inflation. So it's important going forward that we consider reviewing it perhaps, more frequently, periodically, so that now it's in tandem, with the economic trends. That's important. Thank you, Michelle.
Thank you for those insights. One of the biggest concerns for our retirees is the rising cost of healthcare. We all know as we get older, the medical costs tend to go upwards. With this, the PRMF, I believe, was introduced to solve this. Could you kindly explain to our members what exactly is PRMF and how does it work?
Michelle, that's a very good question. And I think it's good to start from the point of demystifying that acronym. So PRMF means Post-Retirement Medical Fund. The Retirement Benefits Authority in 2018 deemed it prudent, and I must say a very good move, to come up with guidelines for post-retirement medical. These guidelines kicked in through Legal Notice 192 in 2018. They require, number one, that for any scheme to be able to benefit from what the guidelines provide, the trust deed and rules shall be amended. And when the term shall is used in a piece of legislation, means it's compulsory, shall be amended to provide rules for post-retirement medical fund. So ideally, the trustees who are here today, we should introspect and ask ourselves, as a scheme, do we have these rules in place in our trust deed and rules? So if you can tick that box, then the next question is, are our members contributing? What the guidelines provide is that members are to contribute on a voluntary basis. But matters voluntary means education, means sensitization, means telling the members why go this way, why go this way. The other option that the guidelines provide is an option for the sponsor to also contribute into that PRMF fund. But for the sponsor, the founder, or the employer to contribute, they have to pass a resolution to that effect and notify the Retirement Benefits Authority that as a sponsor, as a founder, as an employer, they have decided that they want to contribute a certain amount towards the post-retirement medical fund. The guidelines also say a scheme, the trustees of the sponsor may sit back and say, we know that healthcare is a big issue for our members at retirement. Statistics are showing that up to about 60% of the retirement savings that one makes, 60% goes towards medical. So to save on that 60%, can we have a target for our members? And if that is then the case for a scheme that then sets a target, you need to bring an actuary on board. So then the actuary works backwards to say, if the target is to have each member who's retiring, retire with a fund, a PRMF fund of 5 million, or even 10 million, how much should they save per month for the next number, for the next so many number of years to get to this target? With that in mind, an actuary then works out the figures and gives you a target. And with that, you even put that in your TDR, that this is our target. That target means now the members contribute a certain amount of money, and if the sponsor has passed the resolution I mentioned earlier, the sponsor chips in to meet that target. But the point is, the guidelines are in place, the law is in place, it is us as trustees to amend our trustees, it is us to sensitize our members, it is us to ensure that we start saving towards this. Even if the sponsor does not come on board, the person who gets unwell at the end of the day is a member, the retired member, never the sponsor, never the entity, never the employer. So it is us to introspect and ask ourselves, how can we do, what can we do, and how can we go about it to forestall this issue that is a big issue that may come our way. Planning and failing to plan is planning to fail. Those are my sentiments.
Rightfully said.
Very good. Yeah, so the take-up has not been good at all. There are very few schemes that are contributing post-retirement medical fund. And that is concerning. It's actually disturbing because whereas the framework has been improved, now you can put in 15,000 shillings every month without tax. So added to the 30,000 I referred to earlier as a tax incentive, or tax exemption for contributing into a retirement scheme, you can now contribute 15,000 shillings every month into a post-retirement medical fund and not be taxed on the 15,000. So altogether, 45,000 shillings in total. So these are good incentives. The concern is very little take-up is happening. As I speak to you, there are very few schemes in Kenya today that have a post-retirement medical fund in place. Although the framework has been put in place, a lot of the trust deeds have been amended, we are not seeing movement on the ground. We are not seeing members contributing into the post-retirement fund. And now with this new incentive that has taken effect, where you are exempted from up to 15,000 shillings, really, we have no reason whatsoever not to contribute into a post-retirement medical fund. And as you may remember from the statistics we have, the average Kenyan retires with only 34% income replacement. So assume you're earning 100,000. In Kenya today, based on the survey done by the RBA, you're retiring with 34,000 shillings. which is really a very small amount, to cover your retirement needs. Now, those needs, as has been very well explained by Stella, a big chunk of those needs is medical. So if you cannot survive, in terms of rent or living expenses, when you put on your shoulders medical expenses, then you fall apart. And this is what we are saying that to our members, very, very emphatically, please contribute into your post-retirement medical fund. It is for you. It is for your needs, your medical needs, when you come to retirement. Now, let me also say that the persons or the schemes that appear to be doing well are the disciplined forces, shall I say. We're seeing a lot of take-up in the disciplined forces. Historically, they have taken it up very well. And we would encourage other schemes as well to make those contributions. Now, you hear someone say sometimes, is my employer going to match if I contribute? So the reason for not contributing is because my employer has not agreed to match my contribution. Well, it's a good thing if your employer is benevolent to match your contribution to the post-retirement medical. That's a good thing. But even if not, at the end of the day, who will retire? I'm contributing for my retirement, not for my employer's retirement. So it's important that we take ownership of the post-retirement medical contributions. I'm happy to contribute. If my employer joins me to contribute alongside me or to match what I'm doing, good enough. But even if he doesn't, that is not reason good enough for me not to contribute. Because at the end of the day, I'll find myself retired, sick, and unable to take care of my medical needs. And I don't want to be a burden to my children who are struggling to make ends meet. So we strongly urge every member in this webinar, please contribute for purposes of your medical cover in retirement. And let's also do what we need to do as trustees. Let's have the member awareness sessions. Let us have the member education forums. Let us speak passionately about these things in annual general meetings. But also let's lead by example. You as a trustee, talk about what your good example is encouraging or can be encouraging to your members so that we are leading by example.
Yeah, Michelle, I think my fellow panelists have put it actually very, very, very well. Just in addition to what they have said, just like contribution, to a retirement benefit schemes, contribution to a retirement medical fund, an employer is also required to grant that deduction to the employee. So if you're paying a salary and making deductions towards, a PRMF, then as an employer, it's you're under obligation also to grant the employees that relief. And in case maybe you're contributing, privately, perhaps somebody has opted to do so for their own reasons to do so privately, then at the end of the year, when they are filing their income tax return, they should be able to claim that particular deduction, and the effect is it will reduce their tax liability at that particular point, and perhaps end up in a refund, which they also need to apply for it. So it's important that even as we contribute, to this, post-retirement medical scheme, we take advantage of the tax incentive that the government has provided.
And I believe we've all heard the post-retirement medical fund is necessary, and as trustees, we need to make our members aware that they should contribute to the post-retirement medical fund to help them with their medical needs in retirement. Panelists, I believe people learn more if they see others' experience. Do you have any success stories you can share with our members today?
Thank you very much, Michelle, for that question. We have a very good example, and this is an experience, a real life experience, from none other than the former Chief Executive of the Retirement Benefits Authority, Dr. Edward Odundo. Immediately after he retired, he went through a series of medical challenges, which he has shared in public and in forums. Because of the post-retirement medical arrangement he had been saving into, and he was very passionate about it, he was able to receive a cover and payments to secure him so that he was able to surmount the challenge of the medical problems that he had. And who better than him should tell this story? So we're going to have this video played, and this video, from his own mouth, he narrates his experience, and hopefully it will move us so that we do what he did, because it's a course of wisdom.
Now take you to the retirement mantra. I know you have one. You love talking about it. Can you tell us your retirement mantra? You have 7 rules, eh?
Yeah, but 5.
I've heard you talk about it before.
Yeah, I will.
Yeah.
I always, when I teach the pension, I say that pension is not the most important, as most people think. Because I am a former regulator for more than 16 years. I came up with a number of policies, and now I'm a retired officer, and I'll tell you that some of those policies that I used to put in place don't work in retirement. They don't work. They're just policies, theories you've learned from all over the world, and you apply them. But when you retire, it doesn't become true. So what I always say, I came up with 5 mantras of what is important in retirement. Somebody can add. I say the most important thing is medical cover. So if you find when you reach that age of 60 or already 60 something, most of the time your body and everything, you need that cover. I say I was one of the lucky people for almost 40, 50 years. I was covered by the institutions. But immediately I retired, that thing stopped. So I looked for a medical cover. The advantage I had was having been in the Retirement Benefits Authority, I'd seen what other countries were doing. They came up with a post-retirement medical cover, and I introduced it here in Kenya. I was the first person who got it, to get that post-retirement medical cover. Most Kenyans would not put money there. They put money in matatus and such, and think that that will work. So that post-retirement medical cover which we introduced really helped, because it's a one-off cover. I paid it for one-off for life. There are about 5 companies who currently offering it, and there's nothing wrong talking about Jubilee, APA, ICA, we have UAP and CIC, and the new other companies are coming up after that first introduction. So I was the first person who got the first one. That time it was like you need to put in about 2.5 million, which I did, but that was because I was taking a 5 million cover and a 200,000 cover. But you can take a bronze, which is 500 inpatient, or silver, which is 1 million, or gold, which is 3 million. Okay, the amount to be paid are less, and then you take it. When you're a young person, the repayment is very low. If you take the one I took when you are 20, you only pay 2,000 shillings 700 per month for the next 40 years. After 40 years, you stop paying.
Cover for life.
And then after that, you're covered for life. So mine was a joint with my wife, so we were both covered for life. 5 million inpatient and outpatient 200,000, which we have divided 100. Okay, so that really helped, and I always encourage people to make sure that they have that post-retirement medical cover. Another reason why I took it, I'm a cancer survivor. I had a colon cancer, and in 2006 operated here at the hospital, and I have to go and have that check of a CIA, check with the cancer continuous checking and management. So I needed it. Then apart from that, I also got sciatica. This came after retirement, after work. It's a work related, where you can't walk and whatever. So I had a spinal surgery at Aga Khan, and that was also paid for by the cover. Yeah. COVID came. I also got COVID.
Do not stop.
But then, I went through a number of things.
Yeah, one after the other.
God is great.
Yeah.
So that cover became very handy. So
what you tell anyone listening is they need to start thinking about, and it doesn't matter the age, actually the younger the better.
The younger the better.
Because I think one of the problems we have is that I think I'm too young to start thinking about retirement.
Correct.
But what you are telling us now is that this is the best time, even if I've just started working, to start planning for retirement.
It's the best time, because for myself, when I was taking it, I was almost 59, so I had only 1 year
So it was
whatever
more
what I
expensive.
got as my gratuity, I put all of it into my medical cover.
Yes.
So a young person who start at 20, he'll pay only 2,000. Even when you are the executive later on in life, you still continue paying your 2,000.
Yes.
Up to the
It's very cheap and
yeah, very
affordable.
cheap for you.
Yeah.
Not like somebody, but it doesn't stop anybody at a different age to take it, because at the end of the day you'll need it.
Yes.
Because when you don't have that medical cover, it becomes a very big
So
challenge.
you don't have enough income to pay the high medical bills.
Because you find that when you don't have a cover, even if you have an asset, a car, I had friends who are late, you get sick, you can't turn that car into money or into money immediately. Because if you go to any hospital today, they want the insurance cover. They don't want cash. If you pay cash, anytime you find the cash going down, even if you're in ICU, they come to you and tell you, no, look for another place. But if you're covered, they know they have a limit. So that's number one, is the most important.
I want to
None other than the former chief executive of the Retirement Benefits Authority, and a good friend, Dr. Edward Kadundo, and immediately he retired. And that is when the health challenges came in. And you can imagine what would have happened to him from a financial point of view. It would have wiped him out if he did not have a post-retirement medical arrangement in place. Now, I need to add here that even if you start late, the law allows you to transfer 10% of what you've accumulated in your retirement savings account into the post-retirement medical fund. A 10%, which will then mean that you can pay it in one bullet. And you can secure cover for life, as has been explained, in one payment. So really, we have no reason good enough not to contribute into a post-retirement medical fund, so that we have at least a reasonable arrangement to take care of our medical expenses. And we don't become a burden to other people who love us, but would have really loved if we were better prepared to deal with a challenge we know is coming. Health challenges, when they come in retirement, it's not a surprise. As we get older, we expect to see doctors more often. Yeah. So it's no surprise. So why not prepare for what is certain going to come?
And even as members are contributing to the post-retirement medical fund, how do they access this fund after retirement?
Very good question. Access is a very key thing.
Yes.
So now we are asking this question from a point of a member, the scheme, trusted and rules has rules for PRMF. Members have been contributing into the PRMF. Yes. They have now attained their retirement age and will wish to access. So with that background, the guidelines provide three main ways of accessing. So number one, a member may opt, even after attaining retirement age, to leave the funds within the scheme for two purposes. One, to access the funds to buy a medical cover every year. Or number two, to pay for a medical claim that arises as they live their life as a retiree. The other option is a member can actually access the money, take it to a medical cover provider, and get a lifetime cover, just as we have seen here concerning Senior Odundo. The other third option is to access the money, buy an annuity, and we know how annuities work. Annuities it's a lifetime kind of an arrangement where you get premiums. The annual premiums that come off the annuity, you use them to buy annual medical cover. The guidelines also say that a member who opts for any of these three ways to access can also co-opt their spouse, so that their spouse can also benefit from this medical cover. So those are the ways that a member can access right from the guidelines. Thank you very much.
Thank you. Thank you for those insights. And members, I'd like to ask you, are you currently contributing to the post-retirement medical fund? Please feel free to type your answer in the chat box below. And if you are not, are you willing to start after this discussion? Thank you so much. We've talked about the post-retirement medical fund at large, but when people hear about benefits, there's another word that comes to mind, gratuity. So what exactly is gratuity? Because people confuse it for pensions. Is it pensions? Is it something else? Tell us.
Okay. A gratuity can be described as a payment
made to an employee by an employer after a period of service, designated period of service, maybe 2 years or 3 years, in the case of short-term contracts. And I would say that gratuities were very common when we did not have retirement benefit schemes set up. But as we have seen retirement schemes being set up, many employers have opted to move away from gratuity arrangements into occupational schemes. This happened in past years. But now we are seeing a resurgence, as it were, because we have senior government employees and also other employees in the public, public sector and private sector, where gratuities are beginning to be the way of payment, because they are moving away from permanent and pensionable to short-term contracts. And that move is creating a little bit of a disturbance, if I may say, because some of those persons were previously in schemes, retirement schemes, employers are contributing to those schemes, and now they are no longer in the permanent pensionable arrangement, they are now on short-term contracts. And we are seeing a change where now the employer, the government, is now paying a gratuity at the end of the contract, the short-term contract. So it's fair to say that that is a scenario we need to review very carefully, because it can alter fundamentally the way we have been planning our retirement savings. And that alteration, that disturbance, if we don't manage it carefully, may prove to be very wasteful. Because if we access the money and we use it up, then we only worsen the 34% income replacement inadvertently. Because when the money is in your hands, you may actually decide to use it even when you have not planned to, simply because it's available. So the question of preservation may be compromised. Preservation or preserving a benefit may be compromised simply because the money is paid to me, and I don't have the nerve to transfer it into a scheme after I've received it. I have the nerve to use it up. And of course, it's nice to be rich. If a surprise package comes in terms of money in my bank account, then the inclination is not to save it. The first inclination is to use it. So we have that challenge, and we need to rethink the framework.
Further to what Mr. Kilavi has said, I had opportunity to just look at our laws. Because when you then ask what is gratuity, as an advocate, the first fallback is a law. So I looked at the Income Tax Act. Unfortunately, I did not find a definition for the term gratuity. Probably it's one of those things that we need to consider defining in law. I looked at the Employment Act of 2007. That term is also not defined. It is used in the document, in the act, but it's not defined. So as an advocate, we are then trained to look at the dictionary, because then if you're going to define a term, it's not defined in legislation. Fallback is dictionary. So I looked at the Word Master Dictionary, and it defines gratuity as a gift of money for services rendered. In fact, this term stems from the Latin word gratias. So as defined, it is definitely a goodwill on the part of an employer, an appreciation on the part of an employer, where the employer says, for the services that you have rendered me, I then will give you a certain amount of money that is then predefined, liquidated, clear as gratuity. So what then has happened in our laws is that you will find, either in a collective bargaining agreement, a whole provision on gratuity that at a certain percentage that is then paid to an employee at the end of the contract term. This, if it's not in a collective bargaining agreement, you can find it in the human resource manual or policy of an organization. You can also find it at the very bare minimum in an employment contract. But now the thing is, the courts have said that, which is the right position, once we codify it in our documents in the manner that I've mentioned, it then becomes an obligation, a binding obligation on the part of an employer to pay the gratuity. But then Mr. Kilavi has alluded to the issue of, we are now moving from permanent and pensionable, P&P, to actually fixed term nature of employment, especially for senior employees in management position. So what do we do about this? Treasury, in their very wisdom, which I must say was a very wise move, last year, 2024, in specific 10th of July, issued a circular And in this circular, they went ahead to define who an eligible employee is as far as a pension scheme is concerned. I must say this, that 15 years ago, 2010, November of 2010, Treasury had also issued another circular where it defined an eligible employee as an employee who is employed on permanent and pensionable basis. So 15 years later, or is it 14 years later, in 2024 last year, they deemed it prudent to amend that term. So now they are saying an eligible employee is not only one who's employed on permanent and pensionable terms, but one who's also on fixed term contract. And also that employee on fixed term contract may pay their gratuity to the scheme. So for this to take effect, as trustees, we need to amend our trust deed and rules. Number one, to redefine who an eligible employee is. Because you will look in our trust deed and rules, most of them will say an eligible employee is one who's employed on permanent and pensionable terms. And the reality on ground is that most of our employees within the organization are not on such terms. So that means we are blocking them from joining the scheme. So we need to broaden that so that we say an eligible employee is one who's employed on permanent and pensionable, one who's employed on fixed term contract, and that employee is employed on fixed term contract may have their gratuity paid to the scheme. What is then the advantage of paying the gratuity into the scheme? One, when gratuity is paid to an employee at the end of the contract term, it means the employee waits out. If the contract is for 5 years, they wait it out for 5 years to get the gratuity. Every month, the gratuity is paid into the scheme. What happens from the first month? That gratuity starts earning investment income. So that means the employee now is not waiting on a book entry. Is not waiting for a promise. Their promise has been crystallized. It has actualized. And that promise has not only actualized, it is now earning investment income. And that way, we move away, we de-risk the issue of waiting on a promise. The issue of, will the employer be liquid 5 years from now? Will the employer be in existence 5 years from now? And we have to appreciate when Treasury gave the circular of 2010, one of the key things was to move us from defined benefit schemes to defined contribution schemes. And in fact, Treasury said that by July of the next year, 1st of July 2011, all schemes should have transitioned from DB schemes to defined contribution scheme. Why? Why would we move from DB to DC? One of the things was to de-risk, because DB in an essence is a promise that work for us for this number of years. When you attain retirement, we will pay you at this fraction. It's a promise, it's a book entry. But we saw that was not feasible. We saw that we needed to actually have actual contribution made by the employer, made by the employee, put in a scheme. That is why it's called defined contribution. So if 15 years ago we deemed it not prudent to work on promises, to work on book entries, I think it is also not prudent today to continue that route of promises and book entries in the nature of gratuity as it is. It is important to move the gratuity into the scheme so that now it is contributed and it is invested from get-go. Thank you very much.
Yeah, Michelle, I think it's important also to talk about, taxation in as far as gratuity is concerned. Yeah, we have two categories of employees at the workplace. We have those on permanent and pensionable, and they are members of registered schemes. And the policy direction that the government is taking is that people retire in dignity, so they are granted tax exemptions. The pension is fully exempt as long as you meet the conditions. So where does it leave those who are under contract, short-term contracts, who are paid gratuity, at the end of the contract, as it were? So it was also a policy change that gratuity also be exempt from tax. So as we're speaking, payment for gratuity to employees is exempt from tax. Again, it has an effective date. It came effect on 1st of July 2025. So from 1st of July 2025, when you accumulate gratuity, as it's been ably defined by Stella and Anthony, it's actually a payment for service rendered. Offered the service and the employer is appreciating you. So if you are paid today, gratuity for services that you had rendered, prior to 1st of July, the law says that income that you're being paid today, that gratuity that you're being paid today is deemed to have been earned in those years that you offered the service. So what needs to come out clearly to members is that now if you're paid gratuity today, it's deemed to have been earned in the years in which you offered the service. For example, if you had worked for the last 5 years and you're paid gratuity today, So they'll be taxed in those years in which you offer the service, from 2020, up to 2025 and so on and so forth. However, if there's a portion of that gratuity was accumulated after 1st of July, and now we're in August, you're talking about what you accumulated in July and August, that portion will be exempt. And now going forward, if somebody is employed today on contract terms, perhaps a 5-year contract, and there's that promise that is going to be paid a gratuity at the end of the 5 years, then after 5 years, that gratuity will be fully exempt because it has accumulated from 1st of July. And it's important members appreciate that because I think perhaps in the recent past it's not been clear, and members have assumed that the whole amount will be exempt. And perhaps just in terms, just to demonstrate to members the implication of it, somebody who earned gratuity today, and having worked in the last 5 years, you'll find that the implication is quite huge. If it's for the last 5 years, then that whole amount will be subject to tax. However, if that portion was earned after 1st of July, then it will be exempt from tax. And again, as Stella has put it very well, you can opt to avoid that tax burden. You can avoid tax avoidance. It's within the law by transferring that amount to a registered pension scheme, and as long as you had not enjoyed a deduction before. So the first 360,000 per year, perhaps you've been paid 1 million shillings having worked for the last 3 years as gratuity, and you transfer the whole amount to a registered scheme. It means a portion of it is attributable to the first year, second year, and third year, and each year 360 qualifies for exemption. So you'll find even the whole amount will be tax exempt because you've transmitted the whole amount to a registered scheme and well within the law. Yet somebody else who has not transmitted that amount to a scheme will pay tax, full tax on using the pay-as-you-earn rate. So that's basically the difference, the importance, and this is what the government is encouraging members to save, for a dignified retirement. I think that's what I would say, Michelle. Thank you.
Thank you so much for those insights. And clearly, gratuity is an area of concern. It needs more reform, more awareness to our members. So even as we've talked extensively about the tax exemptions, PRMF, for the pension contributions, for gratuity, an area of concern is death benefits for a member in a registered pension scheme. Are they exempt from tax?
Very good question. As a practitioner at Zamara for many years, we are aware that death benefits have been taxable, but they have been cushioned so that the impact of the taxation is softer. One of the ways in which they were cushioned was 1.4 million shillings of the benefit paid at death would not be taxed if the benefit was being paid to the estate. That was one of the cushions. The second one was that the benefit, although being paid at the incident of death, it was on the assumption that the person who had died, or the member, was the one receiving it. In which case, their years of service would then mean that at least 60,000 shillings for every year of their membership prior to dying would then not be taxed, up to 600,000 shillings after 10 years. So that's the second cushion. The third one was then with respect to the 400,000 bands. If they had qualified for the 400,000 bands because of having been in the scheme for 15 years, then we would also cushion it. So although the benefit was deemed taxable, there were cushions around the impact of the tax itself. But now with the changes that came recently, those cushions were removed, all of them. So the view that then we took was that it would appear that death benefits would have to be taxed on the payee because there was no other provision left after those cushions were removed. Now, it looked a little bit disadvantageous because if you are exempting someone who was left on grounds of ill health, how can you be taxing somebody who has died with respect to the beneficiaries and the benefit they get? So we wrote to the KRA and even had meetings with the KRA, and the understanding they gave us is that from their standpoint, the KRA man is here, he will reiterate, the benefit that is paid from a scheme at the occurrence of death is not supposed to be taxed, just like the other benefits that qualify for taxation. So we are waiting for a written confirmation from the KRA on this issue, and immediately that confirmation is received, we'll be able to inform all our clients and the sector at large, because it is a very important consideration. We want to see that benefits are paid without tax, if that is what is provided for, but we also want to see detailed, exact provisions that cannot be impeached, saying exactly what I've said, that a death benefit when it arises out of the scheme is fully exempt. And that's what we are waiting to hear from the KRA.
Okay. Yeah, thank you, Michelle. And as Anthony has ably put it, it's true. Currently, the law is silent in as far as payment of death benefits. We know from a registered pension scheme when a member has passed on and the benefit being paid to the beneficiaries. The provision that was there that exempted a certain portion was now deleted, and it appears as though now that the law is silent, that death benefits could be taxable. We want to clarify, and first of all, we want to confirm. Yes, we've received an inquiry on the same, and we're going to do a written response. We're going to respond to that. And in the meantime, we just want to clarify that the law provides that if somebody retires or rather accesses his fund due to ill health, those conditions, 20 years, having met the retirement requirements or ill health. When somebody is ill and he retires, he accesses the funds tax-free. So when the worst has happened, when the unfortunate has happened, I don't think it's prudent to tax the same amount. We just want to confirm. That indeed it's our understanding. It's our understanding that death benefits will not be subject to tax. When the worst has happened and these benefits are being paid from a registered scheme to beneficiaries, they'll not be subject to tax. But again, we'll do a written response to that. But in addition to that, I think for avoidance of doubt, there are considerations, perhaps just to put it clearly, so that now it's very expressed in law that indeed these benefits are not subject to tax. But our understanding, as you speak, Michelle, death benefits, from a registered pension scheme will not be subject to, to tax.
Thank you for that. Even with taxation, the exemptions, you clearly stated that if you're a member of a registered scheme, you retire on early retirement, normal retirement, if you retire on ill health, or if you have 20 years of pensionable service. So what happens to members who want to withdraw before meeting those requirements? Is there a tax on it?
Yes, the tax is heavy. All the concessions of removing the tax only work when you attain early retirement age, which for the most part is 50 years, or normal retirement age, which may be 55 or 60, depending on the scheme, or ill health grounds, after 20 years of service in the scheme. On those parameters, if you meet either one of them, you don't have to meet all of them. If you meet even one, you can be exempted and you can take your benefit without any tax. But if not, if you have not reached 20 years, you're not living at early retirement age or normal retirement age or on grounds of ill health, the tax that is levied on your benefit is based on PAYE, which is the rate that is used on your salary every month. So it is heavy. But as we have said, it is a choice you have to make because these monies are being saved for retirement. And the removal of the taxation is at the incident of retirement. So when you take the money before you attain retirement, government is taking the position that they should tax you. And the taxation applicable is PAYE, which is very heavy when you compare the position of retirement access and accessing before retirement. And it's important that members be aware of this. It should influence behavior and accessing. We are saying we need to preserve our benefit from the time we join a scheme up to when we retire or up to when we attain 20 years. Because we don't choose ill health. It just comes. Yes. It's not an option that we can visit on ourselves by choice. So really what we are saying, Michelle, is that it's important for this message to be transmitted to all members. Yes. Please preserve your benefit until you attain retirement age or until you attain 20 years of service. Because you're doing yourself a favor Taxation can take 15, 20% of what you've saved. And that is money you need badly when you retire. Why surrender it when the law allows you exemption? And it is your behavior that determines whether you benefit from the exemption or not.
Yeah, what Anthony has said is true. That post December 27th, 2024, there are a total shift in policy in as far as taxation of pension income is concerned. So that now the government is encouraging members to save and access them, upon meeting the requirements for retirement. But if somebody wants to access the funds earlier, we used to have wider bands. By wider bands, we mean that now those people used to access, pensions funds earlier, before 27th of December 2024, we had lower tax rates, such that yes, that amount is taxable, but not like any other employee. The tax burden was lower. Then secondly, there were portions of those amounts that were tax-free. The first 600,000 is tax-free. Then the other amounts are taxed with the wider bands. But all that was deleted. It was all deleted in law. So whoever accesses, for some reason, one wants to access their funds prior to meeting the conditions for retirement, then the tax burden will be quite high. Anthony has talked about up to 15 to 20%. Perhaps just to make it clearer, it can go as high as 35, because that's the highest tax band. That's the highest tax bracket. So depending on how much one earns, the higher you earn, the higher the tax. And just an example that we're sharing on the screen, those are the wider bands that you are talking about. When before December, 27th, 2024, whoever wanted to access their funds, prior to retirement, they had lower, should I say, preferential tax rates, if I put it that way, because when you compute using those tax bands, as compared to somebody who's just earning employment income, the tax rate was lower. However, that one we no longer have. We no longer have portions that are exempt. The first 600,000, the first 25,000 per month, or 300,000 per year. That was all deleted. So, and the implication of that deletion is that the rates that are available now, that once you access the funds earlier, it means it's like any other income. It's like employment income, it's like rental income, and so on and so forth. And we also have a screen just confirming to the rates that will apply. There's a 10%, there's a 25%, 30, and even 32 and 35%, tax bands, depending on the level of income. So it's important that members are aware about the implication of accessing, funds early. Perhaps maybe for some unavoidable reasons, one would want to access those funds, but again, there's an implication to that. Yeah. Thank you, Michelle. Okay.
The National Retirement Benefits Policy that we passed most recently, one of the key things that it sets out is the enhancement, what we are targeting as a country, because the policy sets out what our target is. We're looking to enhance retirement benefit coverage. So if that is our target, it does not make sense to allow members early access. So this change, it looks punitive, but it is a welcome move. If we are going to avert old age poverty, because old age poverty is eating away. You work for 30, 35, 40 years, you live a very decent life. Mr. Kilavi has just informed us that statistics are showing that the replacement income is 34%. So if you are earning, say, 100,000, it means now you reduce all your expenses to 34,000 per month. We are saying 60% of that may easily go to medical. So what are you then left with? And then, olewako, if you had access to this money earlier. And those are the rates we are looking at in terms of tax. Can you imagine up to 35% of that money going because you could not wait it out. I think we need, as a country, to appreciate that we need to avert old age poverty. We need to save and not access unnecessarily. Because by the time you're accessing, you're still in active employment. Avert, avoid, stay away from accessing unnecessarily. Let's reach this target of enhancing our retirement benefit coverage, of growing the target that we are looking to get at retirement. In fact, the standard target is 70% replacement income. So if you're at 34, we are barely doing even half of what is the target. So that should be our target, to get to 70%. Grow the 34 to 40 to 50, 60, 70 and above. So that then we retire in a dignified manner and we do not make our children our retirement plan. I think the days of making our children a retirement plan are long past. Thank you.
Thank you so much for that. Members, we have been told that pension schemes, the money that you save in pension schemes are for your retirement. So we urge you members to kindly put your money there and let the compounding effects take place, and you will retire in a dignified manner, as our panelists have correctly put it. So even as we round off the discussion, a matter that keeps coming up is how do we stay compliant with the law? The service providers, the trustees, employers, the stakeholders at large. Even with these reforms coming up, how do we stay compliant with the law?
I think I'm sure my fellow panelists will have a lot to say on the changes that need to happen on the foundation documents that bind and operate a scheme.
Yes.
But one of the responsibilities of trustees is to make sure that they familiarize themselves with the changes themselves that have happened. And number two, they also ensure that members of the scheme are informed. Because a member will just access his money anyway if they do not know the implications from a tax point of view. So it is our duty as administrators, as trustees, and even as members to want to know before you feel the claim and start chasing the money for payment at lightning speed. It's a good thing. But what are you going to surrender as tax? What are you going to lose as tax? Government has given you a gesture of saying, I will not tax you. You must become aware of that option and then make an informed choice. Yeah. So we need to see more member awareness sessions. We need to see member education forums. We need to see workshops. We need to see webinars. And this is why we have arranged this webinar. And there are many more lined up because we're going to be engaging trustees. We're going to be engaging regulators. And that's why we have KRA here, taking back some of the sentiments. And we're waiting to see what are your comments, what are your views, what are your questions, so that there is consultation, there is deliberation around these matters. But it is important that the member be brought up to speed on these changes and how they can take advantage. For example, we've talked about the need to increase your savings so that the 30,000 shillings you're allowed without tax of monies you pay into a scheme, you utilize it fully. Yeah. We've also talked about the 15,000 shillings you're allowed into a post-retirement medical. Education around those things needs to happen so that at the end of the day, members take full advantage. And also on the benefit access itself, it's very punitive to take money 30% less. So again, it's important that trustees take up this, arrange for forums, invite the members virtually, in physical, in attendance meetings, so that we can see a change of behavior in the saving pattern itself and in the preservation culture itself. We see people preserving the benefits when they are more informed. Who is there to inform them? It is you, the trustee. Yes. And of course, the administrator in Zamara is very ready with a team that is very solid to support trustees to make sure that this happens.
How do we stay compliant?
Yes.
That's a very good question. Number one, we all know that ignorance of the law is no defense. And number two, the good book, the Holy Bible, tells us that my people perish for lack of knowledge. This webinar and many more to come are here to avert that scenario. But as a trustee, you have taken office knowing either elected, you sought to be elected, or either you are nominated by the sponsor. Or in the event you're a corporate trustee, you are in a contract arrangement with a sponsor. So that means in that arrangement, you have no room to be ignorant of the law. You need to know what the law provides. So with that knowledge, number one, the Finance Act each year, and I must say it's commendable, makes certain changes in the retirement benefit sector. So it's important to keep abreast with those changes. Last year, the Tax Law Amendment Act of December 2024 brought these changes, these very good changes that we are speaking about. So it's important to keep abreast with these changes that come. Our regulations are amended from time to time. It is important to keep informed, to keep being informed as a trustee. The good thing is our regulator is also very keen on sending out communiques on certain changes here and there. And these communiques are sent out to the schemes. So as a trustee, are you opening? Are you reading? Are you keeping yourself informed? We, the service providers, the administrators, the actuaries, we, the advocates, are there to hold your hand and to ensure that you stay compliant. But what do we mean by compliant? So number one, the constitutional document of any scheme is a trust deed and rules. So, is our trust deed and rules up to date and in tandem with the changes in law? These changes that came in last year in December, we are now in August, 8 months into these changes, and other changes that have also come in the course of this year. Are we aware of those changes? Have we promulgated, have we put those changes into our trust deed and rules? Are we implementing those changes? For public pension schemes, are we aware of the circulars that come from the National Treasury? Are we putting in these changes in our trust deed and rules? So it is very, very, very important that number one, you get advocates who are seasoned in this space of pension to help you amend your trust deed and rules. And not only amend, explain to you those specific proposals that we are putting in for amendment, why we are putting those proposals, how those proposals impact on your scheme. Because remember, who pens ink onto paper? It's a trustee in signing that trust deed. So you need to know your document in out. You need to have your service provider explain it to you because it's your constitutive document. It's a document that governs your organization. It's a document that governs your scheme. So we are here to hold your hand. We are here to help you stay compliant. We are here to ensure that we are in tandem with the changes in law. Thank you very much.
Yeah, thank you, Michelle. Allow me just to comment about compliance in as far as employers are concerned. Yeah, it's important that employers grant employees the necessary reliefs and deductions because that's a requirement of the law. Initially, some employers will not grant, and now it's now been legislated. It's now clearly in law that the necessary reliefs, necessary deductions, the employer needs to grant the employee. And when we talk about deduction and reliefs, we mean if somebody contribute to a pension scheme, as we've said time and again. Somebody is also including NSSF. Yeah, wherever somebody is contributing, he needs to be deducted from the salary before arriving at the taxable income. Of course, subject to the limits provided for in law. It's somebody contributing to PRMF that you again extensively talked about, up to a maximum of 15,000 shillings per month. The employer needs to grant that deduction so that to lower the tax burden on the employee. We also have SHA. Yeah, members are required to contribute towards social health authority. So there's also a tax benefit to it. So the employer needs to grant the deduction. We also have AHL, Affordable Housing Levy. Yeah, it also has a tax benefit. Yes, it's a deduction on the salary. It reduces the available income, but again, it reduces the tax burden to whoever is contributing. Then those of us who have mortgages. One has a mortgage in a house that he stays in and is paying interest on that mortgage. Again, it has a tax benefit. Up to a maximum of, it should be now 30,000 per month or 360,000 per year as an allowable deduction, thereby lowering your tax benefits. Very, very important that employers comply with that. Then you also have there are people who have insurance policies, be it a life policy, be it a health policy, be it an education policy of is it 10 years, yeah, and above. Again, it has a tax benefit. There is a tax relief that one is entitled to. 15% of the premiums that you are paying. Up to a maximum of 5,000 per month. So it's important that employers also comply with that. And again, there is what we call personal relief. Currently is 24,000 shillings per year. That one is now to all residents, whether you're contributing or you're not, then you are entitled to that relief. And if somebody is salaried, is earning employment income, the employer is under obligation also to grant those reliefs. I think those would be my comments, Michelle. Thank you.
Thank you so much, Stella, Anthony, and Isaac, for your thoughtful contributions throughout this webinar. You have provided us with deeper understanding on matters, pension, tax, law, and we've all heard that ignorance of the law is no defense. So at this point, I'd like to open up the floor for any questions, and I'll direct them to our panelists. You can drop them in the chat, or you can use the raise hand feature and we'll direct them to our distinguished panelists. Can I have the questions on the screen? We have a question from Stephen Opondo. If investment earnings by the scheme are tax exempt, how comes our scheme has paid almost 200 million in tax in the last 2 years? And can that be refunded?
Yeah, thank you, Michelle. A very valid question there from Steve Opondo. Yeah, it's true. The law says that income of a registered retirement benefit scheme, retirement, provident fund, trust scheme, they're all exempt from tax. That is very true. But there have been contentions in as far as portions of that income are concerned. And currently under litigation in court that perhaps you may not be able to comment about it, but it's true that what Opondo is alluding to, the 200 million shillings that they have paid in taxes is not on the whole income. It's not on the whole income of a registered retirement benefit scheme. It's on what we call a registered portion, an amount that members have contributed up to the allowable limit, up to 30,000 shillings. When that amount goes to the scheme and the scheme invests, the income attributed to that particular amount is fully exempt. So it's true that the scheme that Opondo belongs to may have paid some, it's true they may have paid some taxes, but not on the whole income of the scheme, but a portion of it that is now under dispute in court. And I think a good lawyer still would advise us that if some matter is in court, we don't want to comment about it. It was the Tax Appeals Tribunal, and the Tax Appeals Tribunal ruled in favor of the scheme, and currently there is no stay on that particular ruling, but there's an appeal to the same. So until the matter is fully determined by court, then we may not be able to further comment on the same. I think those would be my comments, Michelle. Thank you.
Yeah, I think speaking as a council member of the Association of Retirement Benefit Scheme, myself and Stella, I think we believe that KRA and the retirement benefit sector associations need to engage on this matter. It needs to be removed from court if you want, so that it can be resolved within the sector. We have a very good working relationship, and we believe that that matter is best handled not by the courts, but by the practitioners themselves, the associations that represent the members. The tax is actually not just the principle of whether to tax it or not, but 30% is also very high. We are aware about other investments and unit trusts that pay taxes at a much, much lower level. So there's a whole engagement here as to what should be done. And what I can assure you, Mr. Opondo, is that we have taken up the matter as an association. We will be engaging KRA. The end result of this matter, we believe, will be in the direction of ensuring that the best interests of our members is catered for. And we believe that KRA and government are very sympathetic to that. That's why they've removed the taxation on the larger chunk, if you want, of the sector, the benefits that are below 30,000. And thank you for the question. It is in good hands. We may not be able to get into it in a big way because it's in court, but be assured that we will be engaging in practical ways in boardrooms so that your interests are represented adequately. Thank you.
Thank you so much, Mr. Opondo, for the question. The next question is, what is the position of taxation of investment income on contributions in excess of the tax deductible amount? I understand the tax tribunal made a ruling on the issue, yet it has not been implemented. Yet it is not being implemented.
Okay. Thank you, Michelle, for that. I think this is similar from the anonymous attendee, similar to what Opondo was asking, and you're saying the matter is under litigation. And I think, as Anthony has very ably put it, I think it's the right direction that even the government is engaging, that we need to engage, perhaps in an ADR on the same. So we'll not be able to comment on the aspect of the ruling of the Tax Appeals Tribunal. And as we had indicated earlier, the matter, we don't have a stay order on the ruling of the Tax Appeals Tribunal, and it was ruled in favor of the scheme that litigated on that particular matter. So Perhaps we'll want to limit our comments at that. We may not be able to delve into the details of the matter, but we're looking forward to resolving that matter so that now we have this amicable working solution with the schemes, working environment with the schemes. Yeah.
Thank you so much for your response.
Yeah.
You can take the next question. And remember, you can also use the raise hand feature to ask your questions. From Mr. Wellington Njumwa. Hello, please clarify on taxation of income from investments. Is it wholly exempt or is there a limit?
I think it's fair to say that based on history, based on practice, the exemption has been applied historically with respect to investment income arising out of the contributions that are 30,000 shillings and below. What was previously 20,000, now 30,000. Any contributions that are below 30,000 shillings, the investment income arising from the investing of those monies was deemed to be exempt. But the portion of contributions that exceeded that limit, in many cases was deemed to be taxable. But at the time when you receive that benefit of what was taxed, the investment income was taxed, then you would not pay tax at the end. So obviously, the scheme that went to court was doing things differently from perhaps most of the schemes in Kenya. So it's fair to say that yes, the decision was made with respect to that particular scheme, but always bear in mind that the way they were going about it was different, probably different from what the person asking the question, their scheme was doing. So we are saying that there are differences in the way that scheme was dealing with this matter and most of the schemes, the way they were dealing with it. So it's not possible just to perhaps take that decision and implement it. It may actually be contrary to what we have been doing. And that change needs to be done with proper mechanisms because the matter is still in court, as has been explained. But it's fair to say that we believe that in the engagement that is happening, we will come up with a solution. But yes, the differential is between the portion that is above 30,000 and what is below. The tax treatment between those two has been different. One has been taxable, but at the end, when you receive the benefit, you don't pay any tax on it. And the other one has been exempt from tax. What is below has been exempt from tax.
Thank you so much for your response. We can take the next question. And members, this is an interactive session, so feel free to continue dropping your questions. What is the position of taxation of investment income or contribution? Really, this is the same question?
Yes, I think the same question and the same answer.
Yes, so maybe we can take...
We'll engage and then hopefully we'll resolve it.
Thank you so much.
Very good.
We can continue taking questions. Members, please remember to drop your questions or any clarifications you might need from the discussions that the panelists have extensively engaged in, be it on post-retirement medical funds, be it on the pension reforms, the tax exemptions, and any other questions regarding the industry that you as a member might have. You can also use the raise hand feature and we can take your questions. And at this point, even as we're waiting for the other questions, I would invite my panelists to say a parting shot, something that you'd like to leave our members with. You can start with Mrs. Stella.
Wow. Thank you for the opportunity to give my parting shot.
Yes.
It has been a very engaging webinar, I must say. And even as we wait to receive the questions, what I will urge our members and our trustees is stay informed. Stay informed, stay informed, stay informed. That can never be overemphasized. Such forums, when they come up, please ensure that you come and attend and ask questions where it's not clear. Number two, for the trustees, let us amend our trust deed and rules. That is a constitutive document that sets us as an entity, as a pension scheme. That is a document that governs us. So if it is not in tandem, if it's not up to date, if it does not align with the current changes in law, then we are not doing service, or we are doing disservice to our members. We are not being fair to ourselves as trustees, because most trustees are actually members of the scheme most of the time. And then with those changes that we then put in place, example, the PRMF, let us sensitize our members, because as much as we have, and Mr. Kilavi has said, most schemes have the rules in place, but we do not have a culture of saving towards PRMF. Why? Because our members are not sensitized. Why? Because we have not appreciated what the impact that not saving for medical will have on our members at retirement. We've just had the testimony that has been given by the CEO, the former CEO of RBA, what he underwent immediately, just a few years after retiring. COVID kicked in on him. He had the condition that he had to have a spinal cord surgery. These things can happen to any of us. None of us is exempt. We do not have to wait for the sponsor to contribute to the scheme for us to match. It is imminent upon us to have the rules and to start contributing. And as trustees, we need to set pace. We need to be the ones who start saving, even as we urge our members to save. We are here to hold your hand. We are here to ensure that you are compliant. We are here to walk this journey with you. Thank you very much.
Thank you so much, Mrs. Stella Ojango. I'd like to welcome Mr. Anthony Kilavi to give us a parting shot. A word for the members.
Well, I think first and foremost, I want to thank those who have attended this webinar. We now will be having at least a webinar every quarter, and sometimes two, depending on need. I would urge that we continue to interact. We have realized that in this sector, we need to interact much more. The questions that you're asking are getting receptive responses from ourselves, from the KRA. They are present, and we're going to up the ante, as we say, in terms of making sure that everything that you express here, we are following up. We've had very important meetings with the KRA. We've alluded to those engagements even in this forum. We will continue as Zamara, we continue as ARBS to represent you, members, but we need you to engage with us in forums like this, so that we can educate our members, we can inform our members, which has been said to be a very important responsibility for trustees. I want to conclude by saying it's true that government has given us very generous tax breaks or tax exemptions, but they only benefit those who take advantage of them. So let us not celebrate rain if we have not tilled the land, so to speak. When it rains, the person who is happiest is the farmer who has prepared his field, who has the seed in the ground, because that rain has found them ready to take advantage. And the same applies to us in Kenya. We now have tax exemption on the entire benefit at retirement. But if you've not saved, how will that tax exemption help you? You will hear the celebrations next door from among your neighbors who are taking home a big chunk of a benefit without tax. So I want to urge every individual to take full advantage. Let's save, let's increase our contributions. The tax issue will be resolved, but let it find that we have enhanced our contributions. Not that we were waiting for it to be resolved in order to put in more money. There are people who have saved a lot of money in the past, and they were not sure about the tax position. Now the tax position has been clarified. You can take your money without tax. But there are those who said we won't save because there's a tax man waiting for us. Now the tax man has already yielded ground, but they had not saved. They have nothing to celebrate. So saving is a good thing. We need to sing about it. We need to talk about it. Maybe much more than we talk about the other political things people like talking about terms of office and this. The thing that affects our life most is our saving culture. At the end of the day, our dignity hinges on, and it's premised on, whether we save enough money when we are working for the sunset years when we cannot work. And I think no better person than Dr. Odundo benefiting from something that was his brainchild, the post-retirement medical. I'm very passionate about it. I'm putting money myself, and I want to urge trustees to lead by example. Let us not be talking. Let's be doers, not just talkers. Thank you very much indeed.
Thank you so much, Mr. Anthony Kilavi. Last but not least, our tax experts, Mr. Isaac Karibu.
Yeah. Okay, thank you, Michelle. And thank you, Zamara, for an opportunity that you accorded us to engage. I think this is the way to go. We need to engage more and more so on these issues that are perhaps not clear, the issues that are contentious, with a view of working together, cordially. Just perhaps just a comment to, the stakeholders, be it the employers, the schemes, the regular. It's important to comply. I think that cannot be, overstated. It's important to comply with the requirements. For us, as KRA, periodically we carry out compliance checks and audits. And yes, when you find a situation of non-compliance, the commission is able to, raise an assessment. Yes, assessment will help us meet our targets. Okay, fine, it's a good thing. But at the same time, we're even happier when you find, an employer, a scheme has complied. We found that, their records are okay. They are paying taxes as required. They're taking advantage of the incentives as there that are as required. It's very, very important. It's a good thing when, KRA finds an employer, a taxpayer has complied. So it's not that we're just after raising assessment. So that's very, very important. And the incentives are there for our taking. They're freely, that the government has given us freely, for our taking. So it's important that let not our neighbors take advantage of it and us are not. So it's important that we do enjoy these incentives that the government has given us. Thank you so much, Michelle.
Thank you so much to our able panelists. I believe we have time for 2 more questions. I'll read them out and our panelists can take them on. We have a question from Mr. Albert Anam. Can a member transfer their service period from previous employers to make a total of their service reach 20 years? Okay. As to enjoy the tax exempt under withdrawal?
Thank you very much, Albert, for that very good question. The answer is affirmative, yes. You can transfer your money from one scheme to another. And when you do that, the years of service you had accumulated are portable. You take them with you along with the benefit you transferred. And those years accumulate to 20, and then you benefit from exemption, full exemption on the benefit that you take home, which has been accumulated over transfers made between different schemes. So to your question, we urge that you do that and encourage everybody else you speak to do that so that you can benefit from a tax-free retirement benefit at the end of your working life. Thank you very much.
Thank you, Mr. Kilavi, for the response. I believe, Albert, your question was answered. We have a question from Mr. Simon Kited. Does the 30,000 per month tax deductible limit apply to gratuity contributions into a registered pension scheme post July 2025?
Thank you, Michelle, for that's a good question. Yes, contributions to contribution of your gratuity to a scheme. As we are talking now, we are saying that gratuity will be subject to tax since it relates to previous years. So if you contribute to a scheme and you've not enjoyed deductions before, so you'll enjoy a full deduction of up to a maximum of 360,000 per year. So just to respond to the question, if you've not enjoyed the deduction maybe on your salary in a year of income, then that deduction is fully available. But for example, if you had enjoyed maybe up to half of it, then you can only enjoy the other half that has not been utilized. But going forward, post July 2025, and you've accumulated funds gratuity from today, going forward, it's tax exempt. So whether you transfer it to a scheme, whether you take it home, the difference will be the same. Since we are saying that it's fully exempt, this one will only work. The benefit in terms of reducing your tax liability will only work at this time when a portion of gratuity is subject to tax. So going forward, when it's fully exempt, then I think there'll be need also maybe to clean up the law, because it will not make any difference because the whole income is exempt from tax. I think that will be my response, Michelle. Thank you.
Thank you so much. I believe our questions have been answered. And if they haven't been answered in this forum, we have more webinars to come. We have a conference coming. We have more forums like this coming up. just to educate our members, the stakeholders, on matters pension, tax, you name it, everything to do with the industry at large. Thank you so much for your very thoughtful contributions. I believe we have all learned something, and I believe we will take it a step forward. This recording is live on YouTube at Zamara KE, Zamara Group. It will be live, it will be there. You can refer to it. You can call onto your friends, your colleagues, other people who might want to get the message. And we encourage everyone to keep in touch with the things that are happening in the retirement benefit sector, because it affects you, it affects me as well. Thank you so much. We welcome you to the next webinars that are coming. You can keep in touch with the happenings that Zamara posts on our platforms. We are on TikTok, on Twitter, on LinkedIn, on Facebook at Zamara KE, on Twitter, and on Spotify also. Thank you so much. We welcome you again to the next forum. Asanteni sana.
The Zamara Regional HR Summit is back, and this year it's bigger, bolder, and more impactful than ever before. Join leading HR professionals from across the region for 3 days of thought leadership, strategic insight, and powerful connections, all in one unforgettable setting. Whether you fly in, take the SGR for comfort, carpool with your peers, the journey is yours to design. And with flexible accommodation options from hotels to Airbnbs, there's something for every preference. This isn't just a summit, it's 3 days of insight, innovation, and unforgettable connection in a setting designed to inspire. This is a summit you don't want to miss. Experience HR leadership redefined. The Zamara Regional HR Summit is back, and this year it's bigger, bolder, and more impactful than ever before. Join leading HR professionals from across the region for 3 days of thought leadership, strategic insight, and powerful connections, all in one unforgettable setting. Whether you fly in, take the SGR for comfort, carpool with your peers, the journey is yours to design. And with flexible accommodation options from hotels to Airbnbs, there's something for every preference. This isn't just a summit, it's 3 days of insight, innovation, and unforgettable connection in a setting designed to inspire. This is a summit you don't want to miss. Experience HR leadership.
Ladies and gentlemen, allow me to warmly welcome you to our annual pension convention. This time we'll be holding it in Mombasa at the North Coast. Pride in Paradise, beginning the 22nd, 23rd, and 24th of October. The theme of the conference will be Disrupting for Impact. I'm inviting you as a stakeholder, a regulator, fund manager, custodian, administrator, trustee, HR professional, and anyone who is active in the employee benefit space. Do attend our conference. Let us convene, discuss on the theme of disruption, and see how we can stay focused despite the upheavals, the disruptions that happen with respect to the workspace. See you in Mombasa on the 22nd, 23rd, and 24th of October at the Pride in Paradise.